Short-term business loans, are they the best solution for a cash flow crisis? Firstly, the advantages of short-term business loans. Speed of lending. Short-term finance is mostly quicker to obtain. There's the flexibility, as short-term finance plugs the gaps only when it's needed. But what are the disadvantages of short-term business finance? There's the cost, as short-term loans for small businesses tend to be more expensive. Lending withdrawal. Banks are very good at withdrawing their lending at short notice. What if the short-term cash flow problem turns into a long-term one? There's always the chance that could happen, and if you've only borrowed for the short term, this could cause you a big problem. Personal guarantees pose a risk, and there's always the chance that they could get called in. And the worst case scenario is you could lose your home. So what are the types of short-term business loans? Probably the most popular is an overdraft facility, as an overdraft can be dipped into as and when the cash flow requires it. Credit cards are another option, as credit cards tend to be quite easy to obtain, but these provide very short-term finance. Business bridge loans are an alternative, but the problem with bridging loans is they tend to be very expensive, charging upwards of probably around 1% per month. What's the alternative to a short-term business loan? Increasing your sales and profits, and trade out of the short-term cash flow crisis. Target your key profit drivers. It's amazing the impact that a small increase in the average transaction value can have on your profits. Another KPI to target is the number of times customers return to buy from your business. So what are the advantages of this alternative to short-term business loans? Interest and bank lending charges are expensive, so if you no longer need to borrow, these will be saved. If you're no longer borrowing, then there are no credit checks required. If you've got bad credit, and your bad credit is stopping you from borrowing, then this problem is resolved. If you lack the security required for borrowing, then targeting your KPIs solves this problem too. As you're no longer borrowing, then the risky personal guarantees disappear. There's also the low cost of implementation, as focusing on your average transaction value is mostly inexpensive to implement. There are also the long-term advantages, as your business will become stronger, more profitable, and more valuable in the long term. You have been listening to Russell Bowyer from bowraven.com.